Good afternoon, everyone, and thank you for tuning in to the DoubleLine Diversified Fixed Income webcast titled Reckless or Reckless: Implications of Tariff Policies on Fixed Income Portfolios, featuring DoubleLine Deputy Chief Investment Officer Jeffrey Sherman, and my name is Mike Marsala, and I'm a member of the firm's client portfolio management team. You'll hear from Sherman shortly, but first, a few housekeeping items, starting with webcast announcements. For all things DoubleLine webcasts, you can visit our website to find the full 2025 schedule, as well as replays, and to register for upcoming webcasts. And speaking of upcoming webcasts, you'll notice two highlighted here in the coming months. The first of which features DoubleLine portfolio manager Jeffrey Mayberry, who on May 13th will discuss equity alternatives to market cap indices and the DoubleLine Fortune 500 Equal Weight ETF. The ticker symbol there is DFVE. You can register for this webcast simply by clicking on the register link that you can see here in the player. Additional DoubleLine video content includes a series called Perspectives, which most recently featured Chris Stegeman and Bill Campbell, who discussed trade war risks and opportunities. Perspectives videos and other timely updates can be found by visiting our YouTube page or X account. One of the thought leadership pieces you'll find there is the Channel 11 series featuring DoubleLine portfolio manager Ken Shinoda. Turning now to fund offerings, today Sherman will review the 4 fixed income strategies seen here, with this slide providing fund minimums and ticker symbols. The good news is that all 4 funds have outperformed their benchmarks across major time periods, starting with the low duration bond fund. This strategy has outperformed its benchmark by 124 basis points per annum on a net basis since inception. This same stat for the next fund, the DoubleLine Flexible Income Fund, its outperformance has been 147 basis points per annum. The Core Fixed Income Fund is outperformed by 121 basis points per annum. And lastly, the DoubleLine Opportunistic Core Bond Strategy, ticker symbol here is DBND. This is an ETF that we launched under the Fixed Income Asset Allocation umbrella. It's benchmarked to the Bloomberg U.S. Aggregate Bond Index. It just hit its 3-year track record this March, and since inception has outperformed its benchmark by 118 basis points per annum on a net basis. With that, I'll turn it over to Jeffrey Sherman.
Hi, Mike. Thanks for first for the intro there. As Mike pointed out, I was trying to come up with something that embodied the world today. And with the tariff policy, is it reckless to pursue it, or do we just want them to wreck less than they're doing today? And so it's been a challenging world to be a macro investor when you're hit kind of upside of what was really an unpredicted policy. I was sitting there listening to On the Hour at the beginning and saying a month ago that we should probably be taking President Trump seriously about the tariffs, and here we are a month later. So let's kind of put the setup here. I'm gonna use some of the familiar charts, but get a little bit into the tariff policies here and what we've seen kind of roil through the markets over the last week or so, and talk about how the team has been doing implementation, how we're thinking about bond investing in today's environment, and most importantly, how we're keeping you, our clients, and your clients invested in this process. And so I like to always recap on what's been going on the global GDP or the US GDP front. And here's a long-term chart you can see here that essentially we're really just on this post-GFC trend line back on growth. So, again, this is all in the past. Who cares? Move on. And why I say that is that, if you look at the forecast here on first quarter GDP, once we got the trade deficit data, all of a sudden there was a big roiling in the overall marketplace with the first quarter estimates. And a lot of that has to do with effectively front loading of the inventory build, trying to front load before the tariffs came into place here. And you can see that green line has dipped down pretty meaningfully. And it was shock and awe when that one came out. And then there was the realization that the methodology was actually using gold, including that in there. And so when you actually strip out gold, because gold was something that was heavily imported of that period, it wasn't as severe. And so, but you can see here that there's been, as the data has been released recently, there's been some downticks out there where it looks like, first quarter estimates right now are about -1%. you've got a pretty wide range on the street right now of trying to figure this out, where this will be. But I think it's pretty fair to say that it's not going to be the robust growth that was being forecasted here by the blue chip consensus back, let's say 6 weeks ago or so. And when you look at kind of that estimate, it's bringing, the current estimate for the 2025 experience downward. And I think a lot of this still, those revisions downward, they do implement some of these tariff policies to date, but they don't actually encompass, everyone on the street at this point. Hasn't really kind of updated all of their forecasts. So we'll have to see how this revision looks here. But again, as you think through kind of this environment, if we're going to have, this tariff policy that was announced, and it stays at the magnitude, and it stays for a prolonged period of time, I have to believe that this estimate is pretty aggressive still as well. And so I think this is a world that thinks that still that a lot of these tariffs may indeed be transactional in nature. That is, trying to bring our trade partners together to renegotiate terms of the trade deals out there. But again, so far, the president doesn't seem to be buckling on this behavior tonight now. And to put this into perspective, when you look at the average tariff policy over the last, about 125 years here, what you see is that, we used to have a very strong tariff policy, right? And the scale here is it only goes up to 24%. So it was a pretty robust kind of tariff policy when we didn't really have a really unified global trade system. And so what happened there too is that, as you see, there was this decline post World War II, right? Because you're tariffing things, you're trying to, as we were coming, I said post World War II, I meant to say post World War I, and you were tariffing things to try to get the U.S. back aligned again. And then once we had the market crash of 29, that's the Smoot-Hawley tariff pact, where we started to really tariff that. And some people think that that was probably one of the catalysts that led to some of the Great Depression era stuff. And so, as you can see there, that was a pretty aggressive number. And when you took surveys from the economists, they were saying, well, maybe we're going to get to an aggregate like 6% tariff rate in the U.S. And notice the severity of that red line upward. And so this is the Bloomberg estimate. So it uses kind of the weighted average of all the various estimates out there. I've seen them as high as 26 from some houses out there and some economists today. But notice that there is a meaningful impact here of a change in policy. And so if these are indeed willing, if the president is a man of his word and willing to keep this to stick, this is going to have significant impact on the prices we pay on all imported goods into this country. And so if you want to do it regionally, it seems that if you take a look at this graphic here on page 16, that it seems to be much more disproportionate in certain pockets of the world. And when you look at the level of tariffs here, if you notice the lowest ones tend to be kind of that LATAM region or South America. You also have Australia, parts of Africa that have kind of the lowest level of tariffs out there. That's the 10% basic. But if you actually look at where the heaviest are, there are things that are, there are countries that, first of all, it is China, but the ancillary areas around China as well that have been benefiting from, again, China exporting to those areas. And so, again, when you think about this policy, it is wide, it's rampant. If you notice here, Mexico and Canada don't have the tariff yet, although the auto tariffs there, we do have steel and aluminum tariffs. I think if there's one thing that Trump is committed to at this stage, it is tariffs. And so this is a wall of numbers. You can download these slides where you can ask info@doubleline.com or fundinfo@doubleline.com if you like a copy of the slides here. But I kept this in here so you can kind of see what these tariffs look like across the board. And so again, they call them reciprocal tariffs. It's not really a reciprocal tariff. It's really, if you look at the calculation and what appears to be the calculation, is that they essentially calculated the trade deficit with each country, and to be fair, divided by 2. Because that's what everybody would do when they're thinking of their tariff policy. And so this isn't really a tariff on reciprocal tariffs. It's about trying to balance out the trade deficit. And so Again, that's why you see some exorbitant rates in certain areas, and this is stale now as well, because we know with China's retaliation, we've now retaliated to their retaliation. So the reciprocals, there's a retaliation, and as Scott Bessent said, you better just take it. You need to absorb it. I'm paraphrasing here, but effectively he was saying that if you try to retaliate, it's going to get much worse. And so he said, if you just sit back and take this, this is the high water mark for the tariffs. And so we're going to have to see what the impact is here. But again, not everyone we're going to be a heavy importer into. And so they may not be able to hit us with reciprocity when it comes to tariffs. But there are ways to kind of impact the overall U.S. economy if they want to have a significant impact, and we're degrading their economy. Think about flight of capital. If you're a foreigner investing in the U.S., you may repatriate some of that capital. You may say, I don't want to travel to the U.S. I may not want to consume U.S. goods. And so there may be a lot of what we call knock-on effects that get pretty severe, that aren't just straight trade-based, but they actually turn into capital flows as well. And you've seen that, China hinting a little bit at that. You saw some headlines last week with the French, with Macron coming out and talking a little bit about this as well, that maybe we're going to delay investment in the U.S. And so I think we have to be very careful how we tread on this policy. But one thing's for sure thus far is that the president isn't backing down. And if you look at what Goldman put out, I like this chart. It's a busy chart. I kept it in here too. But the idea behind the chart is to say, what are the tariff impacts on growth? And so this is not the forecast of GDP itself, but it's actually looking at the overall kind of impact from these policies. And so, the trade deficit, by balancing that out, that actually adds something back to it. You can see the tax-like effect on spending, because it is a tax. By the way, tariffs are extremely regressive. I guess it all depends on the basket consumption that you're looking at, but they obviously disproportionately hit the lower income areas harder than they would the wealthier side. It does have an impact on financial conditions. Uncertainty kind of leads to constrained investment. And you notice that green area boycotts too. And so this is something that, again, thinking about what this looks like over time, is that this could potentially be a drag. Now, ultimately, we're trying to get manufacturing back, trying to create new jobs, create these industries. But the question is how long can we go through this austerity and these drags on the overall economy? Or is the president going to have to back off at some point in time? And so you can see now, even Goldman now forecasting that this is going to be pretty painful in 2025 when we look at the year-over-year growth rate. So it's time to take our medicine. I think Scott Bessent, the Treasury Secretary, calls it a detox. The president said there will be a disturbance out there, and I think financial markets woke up to that after the close and the announcements on Wednesday last week, so-called Liberation Day. And if you come back to kind of what we were in all of this, is that we have printed a lot of money over the last few years. We're still above that kind of long-term trend line. And what this shows here on this chart too is, because of the amount of unprecedented money printing we did over this period of time, that we still kind of have some of this excess liquidity in the market. So maybe that's behind the scenes what the president and Mr. Bessent and Howard Lutnick and what they're thinking about, is that they're saying we have enough liquidity and stuff to absorb this. So maybe it's these assets that need to take a little bit of a hit to help us rebalance. Again, I'm trying to think through the fourth dimensional chess game that they're purported to be playing at this point. But we have a debt problem, and we know we have a debt problem. This is where the Doge comes in about trying to hack some of the government. And if you see here, we're back up to we're up over 122% of debt relative to our aggregate GDP. And you can see that skyrocketing level from the GFC, and you can see what we did during the pandemic as well. At least GDP grew greater than the debt for a couple periods of time there, but starting to hook back up again. And the dotted red line comes from the estimates of the CBO. And this is important because the president and the Treasury Secretary keep talking about they want lower yields. And I think ultimately the reason they want lower yields is they know the amount of debt burden that they have out of there. And if you look at the amount of spending that we've been doing as a percentage of GDP, we nearly have been spending about a quarter of overall GDP. It's how much we're spending. So this is not the deficit. This is the actual federal outlays, right? There's some revenues in there that help offset this number, and I'll show you on the next chart. But you can see here that if you look at the amount of spending that we've done really in this last period since we outside of, post World War II, or during World War II, I should say, really since the kind of Reaganomics started to kick in, we've been spending more and more as a percentage of GDP. And again, in those crisis times, like the GFC, like during COVID or the pandemic, those periods of time are where you see those kind of incremental spikes as well. So there's so much for the austerity that we've been trying to, or so much for austerity, we've been spending our way to happiness. And you can see this, it shows up as the trade deficit. I'm sorry, this is the actual budget deficit, not the trade deficit. It's the budget deficit as a percentage of GDP. So you can see here that we got, post that little pandemic period, we got some, kick in GDP. So the deficit wasn't as big. We started spending again. And again, you can see here that we're running at almost 7% of the GDP is what we're borrowing each single year. And this is a problem, right? This is the problem with the interest rates during the inflationary environment we had to raise interest rates. And you can see they've started to tick down a little bit. That's just because some of the debt that's been refied as of late was at lower yields. It wasn't the peak yields that we saw, back in 2022. But what you find here is that this is a problem because of the overall interest. So we're increasing not just the debt stock, but also the price we have to pay for that debt as well. So I think these are the actions that both like the Doge kind of department that they're looking for. And you're talking about trying to bring down interest rates, having a more balanced budget. It's because these things are not tenable for the long term. And if you go by the CBO's own projections here, and this shows what the ultimately what the budget deficit will look like and what contributed to it. Well, this is just focused on kind of that interest coverage. And notice that the interest was very low for a period of time, to kind of like post GFC. Rates really never got really normalized back up. And so when you look at that overall contribution, it's pretty static. But recently, that contribution to the overall budget deficit has continued to expand. And if you look at the actual estimates by the CBO, and it's the baseline assumption of where they think interest rates could be, you find that it's a meaningful number here, that it becomes a larger and larger part of the budget. And what's the aberration is that usually when we run these large deficits, if you went back to this chart here, and you can't see my cursor here, but we usually expand deficits during the recessionary periods, and then we try to cure them and be a little more austere and not as frequently as spenders. But then all of a sudden, back in the first Trump administration, we saw that for the first time in a long time that we started to expand the budget deficit really during what we call the better times. I won't call them the boom times, but during the better times. And then obviously the pandemic came, we got a little snapback, and then we continued to spend here. So this is problematic through time. But normally, when you run these big deficits, it's when you had a challenged economy, and that being measured, in this case, by the labor market. And so what I'm showing here on this slide today is what this is doing is showing where the budget deficit is versus the unemployment rate. And if you notice here, these red lines over here, or these red dots and the lines over there, is that notice that these experiences, that some of the larger budget deficits we've ran have been in the last 10 years. And they've been when the unemployment rate was sub 5%. And so, again, this isn't kind of the traditional type of relationship that you would see. That usually, again, the budget deficit, we were expanding that to kind of counteract weakness in the economy. Usually weakness comes from the labor market. But there's been something different here over the last decade. And so this is kind of the setup we have here, too, is that we're talking about, the Fed and should they be cutting rates? I mean, the financial markets wanted that last week. We had another down day in equities today. But the Fed is struggling to do that because you have the pull effects of inflation being somewhat stubbornly high. And I'm going to cover inflation next. But you also have this idea that the labor market is still very tight. And so this just flies in the face of their dual mandate for them to be wanting to cut rates at this stage of the cycle. And what's happened is that we had a lot of negativity from the business segment. This is from the business optimism tracker that Goldman puts out. But notice the big hook that you've seen here downward in this optimism. And this is where sentiment plays a big deal in marketplace, is that even if President Trump were to reverse the tariffs, let's say we start them and we run them for a month or two, and then he decides to pull them back because it's harming the economy or something. Well, that can be problematic because you may not revive that confidence, right? The economy also runs on those animal spirits as well. But the business community is telling you something here. They're telling you something about they don't like what they're hearing. And it's not just business, it's also the consumer. And if you look at the surveys, you notice that these continue to kind of, everything's kind of hooked down since the inauguration. And that's because of the policies. And the policies don't seem to be pro-growth, at least in the short term. Maybe they are medium to long term, more cyclical and pro-cyclical, pro-growth. But at this stage in the cycle, if we're going to talk about austerity, we're going to talk about cutting deficits, we're going to talk about tariffing the rest of the world and trying to rectify our trade imbalance, there's going to be some pain. And you're starting to see that show up in the data from at least the soft data. The other thing is that I want to warn everybody about taking this first set of data that we're going to get over the next month or so and saying, well, the consumer is going to still be strong. Look at the sales. Remember, people are also stockpiling right now. There's a headline in Bloomberg today about olive oil, cars, and iPhones, right? So people are trying to get a little bit ahead of that, and so you may see this impulse in spending in the short term as people try to think through what the overall implications are. But if you didn't get your car in time, you may be struggling out there to pay that tariff. So the manufacturing side, this is one of the things that President Trump is trying to focus on, is manufacturing jobs. But notice the weakness in the manufacturing. So this is a time series that looks back. The blue lines are the manufacturing. That gold line is the services data. And this is a way of measuring economic activity in those areas. And so when you see that number be below 50, that just means that there's more respondents that are responding less favorably than favorably. And so notice the manufacturing has been weak, really for almost 2 decades, right? We go through little bursts at time where we get a little impulse, but the weakness has been very pervasive since the rise in rates. Maybe it's because it's expensive to build plants. Maybe it's a high capital expenditure. Cost of capital went up. But notice there that you see when we go into recessions, usually the services data dips down as well. So we're right on that precipice today. This data started to weaken a bit, but this is overall economic activity. And I'm going to dig a little bit deeper into manufacturing versus services because, again, we want to bring manufacturing jobs to this country, or at least that's the stated purpose. And I want to show you what that looks like ultimately. But here's the problem. Is that also when you look at the prices paid inside of these, so these are the input costs that go into these, you have more respondents. In fact, almost 2/3 to 70% are saying that things are more expensive than they were the last time. And so what you find here is that you have this idea where the activity is going down, the input costs, the prices are going up, and it's kind of a confluence of very negative events. And you look at the employment picture, and it looks very contractionary. And this is also in the services side of the equation. Now, this doesn't always signal recession when there's fewer people that are hiring than not hiring the services side. But you can see here that this is not usually a kind of area you want, because this leads to contraction in effectively the labor supply out there. So we'll have to see how this continues to materialize. But getting the services data the other day wasn't very comforting to see on Thursday. That was in the middle of all the tariff stuff as well. It wasn't very comforting to see all the components here. But I want to also focus on this idea of goods producing versus service side of the equation here, because we talk a lot about this manufacturing jobs. And if you notice there, that top chart, so we did it in the number of people I always don't. I can never understand when you use persons versus people, but I'm going to call them people in this case. I think when you count people, they're persons. But if you look here, we've been pretty stable for really the last 5-6 decades in how many people work in the goods producing segment. The problem is the population has grown and we do more on the services side. So when you look at the share of overall employment, it's really went down since the 40s. Trump seems to be living in the early 80s. That seems to be where he's kind of come up with this policy of thinking about where we should be in manufacturing. But we've had that since the GFC, or going from, let's say, the early 80s to the GFC as a percentage of the overall employment picture. But it's been relatively stable, in the last, call it decade or so overall. But if we want to go back to that heavy goods producing type of environment, you've got to really restructure the jobs picture meaningfully in this country. And so again, it's even though services, provide in this instance about 85% of the jobs, they also additionally, drive about 80% of the overall economy. So again, we would have to redefine the shape of our economy as well. And again, maybe that's the transition phase that we're going through. But I talked about the Fed and its challenge here in terms of the inflation picture. But the thing that's really helped inflation come down meaningfully is actually that shelter piece. If you notice the contribution here, that light blue area. So what this does, it takes each of these three sectors: shelter, core goods, and core services ex shelter. Services is shelter plus core services. And what it does, it takes their performance, or whatever that inflation component is, times its weight in the basket. And so what you see here is that shelter is always a big piece of our inflationary environment. But notice what's happened here. If you go back from, let's call it the early teens, goods were actually a drag. Goods were a drag on inflation. And you can look there throughout that entire period, and it may not feel like it because the cost of things went up, but they have these adjustments in them called hedonic adjustments for the quality of the good. But notice what's happening. You see where you see those spikes where there's actually a positive contribution in 2019? That's from the first round of tariffs. So we did see a spike in goods over that period. So when they come out and tell you that the tariffs weren't overall inflationary, they are that is true that they weren't broad-based inflationary, but the goods that they targeted sure did experience inflation. And then they reverse over time once we remove them. But notice during the pandemic, we got this big contribution from goods. Now goods is back to that same trend from before. Well, what happens with the tariffs come in? Well, we'll have to see how the consumption looks as well. But I would probably guess at this stage that you're going to see a positive contribution from the good side of the equation as the tariffs kick through and start to pass through in the economy. So we'll have to see if that plays out. But notice here also that services area has been extremely stable post-pandemic. Right, the amount of contribution that it's giving to the overall inflation picture has been a relatively static number. And so, again, when you start to think through this picture, this is the challenge that the Fed has. That's a number that they don't want to see, the 3.1% that you see on the screen for core CPI. It doesn't include commodity prices. But again, we'll also know that some of the base effects, that is the numbers that are going to roll off over the next couple of months, are likely to tick these time series higher, and Jay knows that as well. So the challenge is we have an inflationary picture there. We have now the labor market, which, again, if I was to distill economics into a basic concept, I would say quite simply, if you want to know the economic activity, you always look at the labor market. If people work, people get a paycheck. If people get a paycheck, people spend money. It's what they spend it on, right? And what we found here still in this environment is that we have a tight labor market. You look at how many people are out there in the labor force. You look at how many people are looking for jobs today. And that's how the balance works out. Also, remember that we're potentially changing immigration policy, right? There's been talk of meaningful deportation. And at this stage, how we're going to be able to do that and absorb these jobs, the supply out there, unless, again, we're contracting the overall economy. When I look at the overall employment picture, and we've been looking at this a lot with the Doge kind of characteristics, and you look at how many people are actually in the overall employment force, there's roughly 160 million or so working, of which 3% work for the federal government. I'm sorry, 3 million, sorry, not 3%, 3 million, or roughly it's about 2%, right? You have 3 million. And so if you look through kind of what that looks like, well, even if we got rid of all those government jobs, again, this is the government at the federal level, right? It's not really a meaningful part of the overall labor force. Yes, unemployment rate would go up by almost 2%, right? Because they would all be gone. But notice where most of the kind of government workers are. They work for state and local parts of the overall economy. So I think a lot of times these numbers get confused together, where people would want to think that, oh, well, there's about 15% that work for the government. That is true, but not really for the federal government. It is a small piece. And so again, if you're talking about how many jobs that we're going to take off from DOGE, again, it's starting somewhere. There may be some knock-on effects still there, where some of the local side too has to take some of those cuts as well. But again, I just find it interesting to look at what the overall population looks like and what that composition of the work. And so again, the nice news is the private sector does drive the bulk of employment in this country. That's what makes America great, is that we are out here trying to work in the private sector and try to be efficient. But in general, just looking at this dynamic, I just want to point this out, because it's not like we're going to hack 23 million jobs during all of this. But you have seen kind of the jobless claims. And if you follow our work, we like to look at the jobless claims that they come out weekly. And again, what you find is that if you look at the initial claims, there's some seasonality and noise in it. That's why we use that dark line in there. We need to move some of these bars around so they don't block the data. But if you look at the continuing claims, they are at a new high. And the thing is, this chart is a little deceptive too, because if you go back before the pandemic, roughly about 2 million people on continuing claims is about where you were before. But it's undeniable that we're at a new area here, and some of that are from the federal government as well. But if you look at as a percentage of the labor force, right? Because I'm going back to this chart and I say, wow, it looks very scary. This looks like we're in a bad place. But if you divide it by the overall labor force, you see that, okay, well, there's only about 1.1% of the labor force that's actually on some form of unemployment insurance today. So yes, these are people that are out looking for jobs, but it doesn't look as bad when you start to look at it as when you actually bring in the denominator effect. And so this is the other data where you can look at is job openings. This is a JOLT series. It has a little bit of volatility in it, but what you've seen here is that the quits rates have somewhat stabilized here. We're going back to kind of that area where we were pre-pandemic. The hiring rate is slowing, though. We are below where we were pre-pandemic, and the amount of jobs opening have really diminished in a meaningful manner, since the kind of peak COVID days. And so again, as I think through, the other ultimate policies, if behind the tariff policy, we continue the deportation of people who are employed, not for criminals or people in jails, but people who are employed, where do they get absorbed? Where do those jobs get absorbed in our labor force today? And that's a big challenge as well. We started to see wage growth moderate a little bit. Again, still above pre-pandemic levels, no matter which of these two time series you use. And the good news is that the wage growth has been above the inflation rate. So at least, again, the average worker in this case is doing better than the average inflation rate. Now, it depends on what your inflation rate is ultimately. But here's the ultimate problem. I keep using this chart because I think it embodies the sentiment out there that prices are high. Well, even though you're making some progress, I was saying that the wage growth is greater than inflation. What you see here is that the cumulative effects of both is that you're actually still behind the 8 ball when it comes to the inflation rate. And so this is part of the reason that I think you have such a negative sentiment in a lot of pockets. I think that was part of the electorate when you saw people vote. They wanted some change out there. But unfortunately, probably these tariffs may lead to another round of inflation. You heard even Jay Powell saying that last Friday. Savings rate continues to remain kind of at these depressed levels. This is the savings rate as a percentage of income. So this doesn't mean it's not looking at people's savings accounts. It's actually the rate that they're saving at. And maybe this, kind of negative sentiment leads to people to want to save a little bit more, or at least rethink their consumption basket. So with that, I'm going to wrap that part of it. Let's get into what's been going on in the markets. And I'm going to focus on the fixed income markets. I'll talk a little bit about our funds, and hopefully there's some time for a few questions. I see there's some questions out here in the queue. I like this chart, for showing the different types of volatilities. So we saw the big spike in VIX late last week, and then especially on Monday. I think at one point it hit almost 60 intraday on Monday. But that's the black line. The blue line, which is a bit more elevated in these scales here, happens to be the rate volatility. And not shockingly, as the markets try to digest what's going on here, you've seen a fair amount of volatility. Notice what started to tick up finally, though. Even all these other bouts of volatility, that red line hadn't really kind of ticked up in a meaningful manner. Little small peak and a little bit of spread volatility. All of a sudden now the high yield market is starting to show some of this volatility as well. So if we'll talk about the valuation in a bit, but ultimately you're starting to see actually credit markets go, maybe all is not great with all the policies here, and maybe we need to command a significantly higher risk premium. If you look at last year's performance, who cares? Let's talk about what we're doing right now. So if you think about where we are right now, you've seen a pretty good performance in the bond market year to date. And the stuff on the far left, those are the government-backed areas or government-guaranteed areas. They've done the best. There's been a bit of a flight to quality there. You look at the higher quality parts of the credit markets, especially in the securitized markets, they've held up quite well, even with this latest bout of volatility. Your investment-grade corporate bonds, right, the higher quality names in corporate America have done quite well. They're still up for the year. But it's that riskier parts of the market that have had more suffering. I do find it pretty amazing that emerging market corporates have done almost as well as U.S. investment-grade corporates over this period. It hasn't had as much volatility as the other areas. But notice this is a risk-off environment, right? That's what's happened. If you want to look at this a bit further, look at the credit year-to-date performance. And you can see here that it pretty much goes by, if you think about liquidity and you think about quality, what you find is that it's the higher quality stuff or the stuff that wasn't as rich in the marketplace, like CMBS, those are commercial mortgage backs, right? The highest quality IG tends to be the best here. It's more of a duration type of trade. But the lowest down there is the junkier parts of the high yield market. Notice that loans have done much better in this environment, and that has to actually come down to valuation as well. Spreads have not weakened as much. The retracement in spreads has been about a third from the tights that what we've seen in the high yield market. And so that loan market has been where some of the hairier names have been for a while. And so I think investors did not have tight evaluation there as well, but still negative signs all across the board there when it comes to those riskier parts of the market. You look at yields. Yields have been volatile over the last few days. Definitely, I'd say they've been volatile all year. Look at some of those kind of peaks in the 10-year and coming back down. But it's very interesting. And I look at the market today, sitting north of 420 on 10s today. It puts us right dab smack in the middle of the trading range where we've been really this period. If you take the low, since we were there, kind of in, let's say, the lows of 2024, and you take it to kind of that high period in the 2023 experience as well, we're really in the middle of that range. And so for all the choppiness and all the uncertainty out there, it's kind of put us back here. What has happened, though, is the front of the curve has been coming down as the market is thinking that the Fed may need to cut interest rates sooner than the Fed was signaling in their dot plots from the last meeting. But I think what's interesting here, and I was explaining this to someone, that it kind of reminds me of like an anti-Minsky moment where you have this weird, unstable world, very uncertain, that leads kind of to this stable side because the extremes are so extreme, but the probabilities assigned to them are very similar. And so you end up back in this kind of strange equilibrium, even though you don't have a world that feels in equilibrium today. But one thing that does jump out at us, and that's the long bond. If you look at the right-hand side, notice that when we've seen these rallies in the blue, in let's say the 10-year, in the 5-year, you're not getting that same response mechanism from the long bond. And this is something that, the team has been talking about for many years, that, maybe the market is worried about the fiscal situation, and the way you express that the most is through that part of the market. Another thing to think about is the steepness of the curve. And these are spreads. These are 2s, 10s, 2s, 30s, and in the multi-sector funds, we do have some of these type of trades on in the portfolio. This curve this is as of yesterday. These curves have steepened further today as well, especially 2s, 30s. I think it broke 100 today. But what you find here is that the shape of the curve is giving you some sort of mechanism, and maybe this is what Jay Powell and the Fed were saying. By a slower growth environment coupled with high inflation doesn't allow us to kind of have have this big rally on the back end, because the market is interpreting the idea that when we have that downturn, that ultimately we're going to have to throw more money at it, like we've done in all these other crises. So again, we'll have to see how this continues to play out. But when people ask about what our favorite kind of view on rates is right now, I still like the steepener as one of the best ways to think through this current environment. And you can see that the break-even inflation rate has come down. This is how the market prices 5-year inflation. The way I think about break-evens, it says like what rate makes you agnostic to owning treasuries, nominal treasuries, versus owning TIPS, or the inflation-protected version. And the market says 230. So it's the market's best guess of where inflation will be over the next 5 years, 2.3%. So the market's pretty well contained here, right? Even the fact, and this trade's headline CPI, it's probably come down a bit lately because of oil prices. We've seen some meaningful repricing where WTI traded below 60 there for a little bit as well. But the market's pretty calm on this inflation front. So even during the COVID days, you can see here when we got our 9% inflation, the market was kind of looking through that, and it continues to do so. And this is one thing that makes Jay Powell feel better, that he says inflation expectations are pretty well anchored there. I get a lot of questions on the dollar today. I love this chart just to explain. If you want to know the direction of the dollar, look at the 10-year Treasury. It tells you what to look at here. And you can see this correlation is extremely tight today. And that's because we have been the carry trade. We've had a higher yield than the rest of the world. And so that policy leads to having some higher yields. It's kind of led to that imbalance in the dollar. If you look at the Barclays Ag today, it yields about 460. You're getting some compensation on that side of the equation. These numbers used to be closer to 5, but now it's 460 with some of the rate moves we've seen, and some of that's again, a lot of the spread widening didn't take place in the IG market, but in those other pockets. But there's a potential here for investors to have a stable income stream. I just use this as a proxy for thinking about the market, and bonds are actually doing their job on this year-to-date basis. Where they're providing some stability, where you have stock markets, especially in the large cap space, down more than 10%. Fixed income yields, I think this is a very telling kind of part of the market that, we had some very gapped out yields. That's what these whisker and plot charts are. But you can see here now that our current yields are pretty high for the high quality stuff relative to history, and everything's higher than this long-term average. But it's only the higher quality that are kind of near those kind of upper bounds of the overall yield environment. And so again, as a fixed income investor, there are ways to get 6, 7, 8%. And if I think about if giving the task of allocating money for the next 2 years, put it in a lockbox and forget it. If I was thinking about the prospects of investing in the U.S. equity market or building a portfolio of credit today, I would feel much more comfortable owning that portfolio of credit where I can get something like a 7, 8 yield. At least if I can get 8 over the next 2 years, I think that's a return that probably outperforms the S&P, at least from a standpoint of where the overall kind of valuation is. And look, spreads have widened. And so what we show here is the change from the year end, and also the change really since quarter end. And so, look, high yields out 162 basis points year to date, but 102 of that have occurred this month, right? And so you see here that even with these sharp movements, most of the movements have come recently, and it's not something that's been building over the course of the year. I do point out at the bottom there, CMBS, though, we actually are still tighter than where we started the year in that space. And again, some of that is the perception of the risk in that market, and those spreads are a little bit wider. So the good news is that credit was very tight. We've seen some widening, but the bad news is it's still not completely cheap. And if you really look at where we are in today's market, we even with that massive widening, now high yield is in the top, the top 30 percentile of its ranking over the last 10 years. And so I'm focused on that blue bar kind of in the middle there. Spreads today, you can see high yield got to about 450 yesterday. I didn't get an update on that before the call today, but 450, that puts you almost near the top quartile in terms of cheapness. But again, there's still a long ways to go to say this stuff is screamingly cheap. And so the good news is this repricing has helped a bit, but you see the IG market, it's still below median on this side. The ag is still pretty tight there too. A lot of that has to do with the treasury market being inside the ag. But also notice what's really cheapened up, at least in its valuation, is that front of the curve in IG paper. And look, the AAA segments of the market in CMBS, RMBS, CLOs still have a pretty cheap valuation out there. And again, they haven't been as sensitive to the swings that we've seen in the lower quality pockets of the market. So when people are asking us today, like, is there a screaming buy in the market? I don't think it's a screaming buy to be dumpster diving in some of this low quality credit. But I think putting together high quality credit portfolios today still makes a ton of sense. And also you can have the ability to offset some of that risk with things like agency mortgages as well, which is going to lead us into the portfolio positioning. So I like to always start with the low duration fund. The low duration fund is kind of focusing on, as it says, the low duration part of the market. So this is DBLSX for the institutional share class. This is a mutual fund. And you can see here that the front of the curve yields about 490 today, even after all the violence we've seen in the markets, the whippy nature of rates. You still got a yield that's above cash today that is pretty meaningful still as well. Also, when you look at the composition of the portfolio, and you notice in there, we have a fair amount of government bonds, right? We have the 2-year treasury in there. You can see our duration is about 1.68 years. It's been helpful in some of this rally on the front end. It's helped us a bit as we lengthen that out probably about 6 months ago now. And if you look at the contribution of the overall yield, you can see that all parts of the portfolio are kind of firing to drive that. That's the stacking of the bars on the bottom left-hand side. But notice here, about 30% of the portfolio sits in the government-backed category. We have a little bit of cash out there. We have about 2/3 in credit. Normally, we run 75, 80% credit in these type of funds. Notice in here too, non-agency CMBS is our biggest position in the portfolio. If you want to know what that looks like, it's not the highly risky stuff. It's what we do in our ETF, DCRE. If you look at our ETF in the CMBS side, that looks like what we own in this portfolio. Some people ask me, like, how much conviction do you have in DCRE? I say it's our largest credit position. I've got a lot of conviction in it. There's a reason that we launched that out there. And we have been paring back our CLO positions. We've been letting some of that go through the refi market. We've also been a little bit of a seller ahead of this kind of carnage we've seen lately. And so we've been pretty steady at the wheel over the last couple of weeks. We met with our asset allocation committee. We met towards the end of March, and we thought, there's turmoil probably coming, there's uncertainty coming, but we did make some moves over the recent history. And notice the credit quality. That's what's important to me, is that when you look at the below investment grade positions in the portfolio, it's really less than about 5% of the fund. And in fact, some of those unrated securities are actually, if you had to map them out, would have an investment grade rating. So in general, this is a very high quality portfolio. We're picking up spread to cash, and we're trying to manage the volatility through the cycle. If you move on to kind of a more risky version of credit funds, and this is the flexible income fund. And so the flexible income fund, you can see here on the left-hand side that it yields about 620 basis points today. That's a pretty attractive yield. It's meaningfully over cash, but this definitely has much more risk than the low duration fund. It is more credit centric in nature. We do have things like government, like treasuries. We have agency MBS in here. We added to those positions. We cut some back when we cut some back in September when the rates were getting low. We went and bought some more credit, and we've kind of rotated that trade back out. We did that in February as well. And you can still see we still own 70% of the portfolio in credit, but over a quarter of the portfolio sits in the government-backed area. And what we've also been doing over the last couple of years, which has made us feel a lot more comfortable, is we've been shedding a lot of our below investment grade exposure. Yes, we still have about 20-25% of the portfolio that sits below investment grade, but at a normal part in the cycle, let's just say we're not depressed, recessionary areas, but let's just say we're emerging out of that. We usually run around 50% of the portfolio in below investment grade. So this is a thematic idea we've been doing across all of our portfolios of thinking through where we are in the overall cycle, where we're being paid for risk. And all those spreads have widened a little bit. I don't think the wides of the year are in at this point. I think we're going to have to deal with this uncertainty for a while. And that will probably create a better buying opportunity for us as well. So again, this is something where you're utilizing the whole team at DoubleLine. This is using all of our credit capabilities and expertise. It's using all the macro stuff to feed into to kind of build a more stable type of income stream than to say outright owning one single sector of the market. And we have something similar in the ETF space. That's DMX. If you look at the multi-asset credit fund there, it does very similar to what we're doing here. The main difference being that we don't trade rates in the government backed. It's a pure credit play based on the views of the team here. So again, I like this type of portfolio. This one's going to have more risk, obviously in a low duration, but those that are looking to kind of make a tactical play right now, it's an interesting kind of composition of that portfolio. And at some point, if credit gets beaten up enough, we'll sell some rates down and we'll go out there and we'll buy some of those kind of beaten up sectors of the market. So it is a bit more tactical than you'd see in our low duration side, of course. And then the last mutual fund is the core fixed income fund. This is DBLFX. This is the multi-sector process. This goes through our fixed income asset allocation committee. And when you look at kind of how we're composing this today, you can see here we have a lot more balance. And back in February, we trimmed risk in these portfolios. We took about 5% of our credit down. At that point in time, we were running closer to 55% credit and 45% government backed. Today, it's more evenly balanced, about 50-50. And that was, again, talking about valuation. Valuation was tight. We saw that in some of those charts. And on top of that, uncertainty was increasing. And when uncertainty increases, you need to command more of a risk premium or more spread in your portfolio. And so we thought it was prudent to be able to kind of trim a little bit of that risk. We did go ahead and buy some rates and the likes and agency mortgages. So I think we split that, we did split that 5% that we raised, 3% to the agency mortgage market and 2% to treasuries. And you can see the yield advantage on the index, if you look at the left-hand side, is about 80 basis points today. And that's because, again, we have higher quality in the portfolio than we typically run. I would say through a normal part in the cycle, we normally run, closer to 30 to 35% below investment grade. And you can see today, if you look at that below investment grade component, that it's less than 15%. And so again, thematically, this idea of owning, higher quality credit is something we've been talking about really for the last almost 2 years. And it leads us to have a little bit more stability when we have some of these crises that are going on in the marketplace today. And then the last offering that I'm covering today is the ETF equivalent. This is DB&D. You can see here, very similar allocation, same folks running the money, did the same ideas here when we were talking about paring down the market. We have a little bit more credit just because, again, it's like a 1% difference because of just some of the assets that we own that we like those a little bit better, specifically in the high yield market. You can see that there. But in general, again, the thematic trades are very similar. And so when you look across the suite, I think bonds are doing a good job. They're doing what they're supposed to be doing. They're paying you cash right now. These portfolios are throwing you off between 40 to 60 basis points or 40 to 55 basis points a month, depending on which one you're looking at. And what they also do is they have the ability to have some price upside. I mean, there's probably going to be meaningful volatility as we try to digest more and more news on these trade policies. But ultimately, that's the team here at DoubleLine. What we strive to do is try to keep you well invested through the cycle, not get over our skis, don't cross the double line of risk, and be out there and let you have some stability there in the portfolio. And when the market gets very exciting and things get pretty cheap, that's when we'll pounce on the opportunity. But for now, I don't think that's the message of today. If I was giving any advice out to the administration, I would point them to the title of the webcast and say, don't be reckless, please wreck less. So with that, I'll let the compliance folks look at the slides. And what I will do is move over to the questions here. And so just bear with me while I do that. Let's see here. All right. So yield curve higher in later years now versus the past few years. Not really sure what you mean by that. I do like the curve steepener, as I said there. But I do think that the steepness in the curve may indeed come back because I think the market, even if you start to see a slowdown, we see some recessionary kind of behavior. I think that the bond market will be prudent enough to know that inflation can rear its ugly head once again, and that leads to a positively sloped yield curve. So that's kind of my view on that. Someone said this is beginning to remind me of the oil embargo in the 70s when everything had to be repriced as it worked its way through the system. Very good comment. I'll leave that one as a comment from you. And I think that is a good way to think about it. If the 10-year rises substantially, what would you anticipate the impact to be on high quality cumulative preferreds? I don't know. Yes, I don't know. Someone said no tariffs on Greenland. That's really interesting, isn't it? Maybe that's because it's a U.S. territory. I joke, whoever said that. How are you approaching duration in this environment? What caused you to change that? If we got a back up in rates a little bit from here, I think we'd want to buy a little bit more. On DBND and DBLFX, we did extend the duration a little bit through that credit move because we sold some shorter credit. And what we ended up doing was we rotated into these other assets that had a little bit more duration in them. So we, instead of trying to adjust at the portfolio level, we let that happen. And so that's what we've seen on that. I don't love duration still here too, just in terms of like, what if we get some policies that, are pro-growth and they're inflationary too. So I think right now the thing is to keep this even balance in the portfolio, and that's what we're doing. Someone says, what's the likelihood we see stagflation? It's greater than 0, less than 100. But again, I struggle with what a definition of stagflation is, but I think we're definitely going to continue to have deflation. It's just whether or not what the stag looks like. Let's see. How do you see IP protections for USA companies? That's one aspect of trade agreements is protecting IP. Like I think that's a great point. That's what's important. That's what we actually, the first round of tariffs on China were to protect IP. I think you've seen that through kind of our chip wars we've done of having different levels or caliber of chip, that the high potency or the most high processors don't go to our non-favored nations out there. And so I think that's very important. I'm just fearful that, again, to me, like the worst case here is that it's retaliatory in a case of prohibiting investment in the U.S., prohibiting owning assets, or using their various like pension schemes to do that. Can Doge have a meaningful impact? Probably not. But as Mr. Gunlock said when we were talking at a client event in Texas last week, but you got to start somewhere. And I think the intentions seem right. I just don't know about using the sledgehammer approach there. But again, we'll have to see what actually comes out of it. Is there any justification for the concern over trade deficits with some countries? I think Trump just believes it. Trump believes that the U.S. has been getting ripped off. He's talked about this for 40 years. He talked about it in his first term, and now he's taking action. So I don't think we have to sit here and rationalize it or justify it. It's what he wants to do. He's using it with the stroke of a pen via executive order. We'll see if Congress tries to do something, because technically tariff policy should go through Congress, but technically a lot of things should go through Congress. So I think the idea here is that, I think to justify it doesn't matter. You have to play the cards you were dealt, and that's kind of where I'm trying to think about it. How much of goods production involves automation and robots? Great question. we're going to talk about the auto industry, and we need to create more autos in the U.S. and a lot of those are created by robotics, right? So the idea is that the cost goes up, and maybe we don't employ as many people as well. So that's another thing to really think through. The risk he said, I heard some talk about the risk of foreign nations. Foreign nations hate selling treasuries in retaliation. In theory, that would raise the yield. I think you mean that they will sell treasuries. There's a potential there. There was a buzz on the trading desk yesterday. That's why rates went up yesterday and today. China was a seller. I don't know if we can substantiate that point. We won't get the data off the report for a bit, so we have to look at it. But there's another question on Doge cutting government besides workers. I don't know. I don't really know what Doge is doing. So they just say they're making the government more efficient. And so we'll have to see what that is. Look, I'm all for streamlining. I'm all for efficiency. I'm all for using technology. We've got to figure out how to do it. If we can do it cheaper, that's a good thing as well. How do we develop a labor shortage when the participation rate is only 62%? The labor rate participation rate, how can we develop a labor shortage, is that ultimately those people don't want to work. So those people don't work. They may take care of family members. They may be at a point where they just don't want to as well. But ultimately, you've got to force people to work. And fortunately, you can't force people to do anything. Let's see, Bitcoin and gold is safe haven. Look, gold has obviously proved a bit of that. I don't know about Bitcoin. To me, it looks like a risk asset. It looks like a levered NASDAQ trade to me. So I'm not really sure if that's the safe haven that people think it is. Again, I don't know. But if I was building a safe haven, I'd rather own gold today. Performance of middle market direct lending. Go ask the folks that just launched that CLO fund out there. We don't really traffic in that middle market stuff. Option-based ETFs as an alternative to bonds. Look, they generate high income. We noticed that some of the buffered funds are now participating in the downside because those strikes got moved and didn't rebalance quick enough. So, look, they're good in an environment of high volatility, right? Because you're selling the option away. So they have a place, but they're not just a replacement for true kind of stability and income. They have a little bit different kind of profile there. Someone's saying, it's a long question. Duration mix of treasuries and how treasuries are likely to adjust it going forward. Essentially, they're asking about the treasury market structure. What I would say there is that Scott Bessent, was very critical of Janet Yellen and her way of operating. And then when he did the first quarterly refunding announcement, he followed the same program. One is that it's easy to criticize. It's hard to do. But the thing is that you also have to remember the market structure we have to preserve in some manners because we need to provide liquidity to the market out there. And also we need to provide liquidity how we finance. Again, what we're seeing is the structure did stay in place under Bessent from what was the previous administration. I guess we'll see once we get these new policies in place, does he change his tune? But it is very hard to implement. You can't just flood the market with a bunch of bills. You can't just flood it with 30-year treasuries. You have to bring that balance out there. And as part of what brings stability to the treasury market is actually having those predictable type of coupons. This person's saying they joined late. Can I repeat something? Download the replay. You can hear me again. The rest of us don't want to hear me talk again. Let's see. Next says, let's see. Do you have a framework for estimating fair and attractive yields for longer duration treasuries? I mean, usually the old adage used to be that it should trade something around nominal GDP. That's kind of how people think about 10s and 30s. And so that's kind of a framework. So if you think about where we are today, let's say we have inflation rate of 3, maybe growth is probably 1.5 currently, 4.5 kind of seems reasonable as well. Next question, any risk of Bessent resigning? I don't know. That's a big task, to step away. Scott Bessent, is purportedly a very smart gentleman. He's been in this business a long time. He purportedly knows what he's doing. And I say all that because he's very supportive of this tariff policy. And that is the thing I can't see there. I don't think Besant resigns unless he disagrees with the administration. From what I understand from folks who know him, or at least have been friendly with him over the years, is he is a man of high morals and integrity. And so I think the risk is that he disagrees with the direction, or that Trump is trying to get him to do something there. Someone's asking DBL versus DBND, completely different risk profiles. DBL is a closed-end mutual fund with leverage, and DBND is kind of a core plus solution in the ETF space. So different risk profiles. I expect DBL to have like 2x the vol of DBND. So that's one to think that. Someone's asking, have we been getting ripped off? I hope you haven't. Do your diligence. Don't get ripped off. My thoughts on DeepSeek. I think it's a great thing. And someone says, tell Jeff Gunlock that someone says hello, and I will do so. That's someone. So thanks everyone for joining us today. Appreciate you guys sticking through it with me. It's been a long webcast, I know, but there's a lot going on. If you have concerns, you have questions, you need more information, always reach out to your folks here at DoubleLine. We're happy to try to help you, guide you through this tough time right now. So thanks again for your support, and I'll be back talking to you in a few months. Thanks again. Bye-bye.